Here is the comprehensive market analysis for the Walt Disney Company. Current stock status, ticker DIS. Status, market closed. Data from Friday, November 21st, 2025, closing session. Closing price, $104.28. Intraday change, plus 97 cents, plus 0.94%. Day range, $102.69 to $104.78. 52-week range, $80.10 to $124.69. The closing bell on Friday, November 21st, settled shares of the Walt Disney Company at exactly $104.28, marking a near 1% gain to cap off a week of intense volatility. If you are watching this on Sunday, the market is currently closed, and these figures represent the final ledger from the last active trading session. But don't let that green percentage sign fool you into thinking this was a calm climb. The intraday action saw Disney bounce off a critical support level at $102.69 shortly after the open, only to face rejection near $104.80 by lunch. The bulls stepped in during the final hour, pushing the price back toward the upper channel, suggesting that despite the noise, big money is starting to position itself for what comes next. This brings us directly to the tension between what the average retail trader expects from Disney and the stark reality of what is actually happening inside the mouse house. The prevailing narrative, the expectation, is that Disney is a legacy media dinosaur currently in a holding pattern, simply treading water until CEO Bob Iger finally hands over the keys in early 2026. The belief is that, until a new name is on the door, the stock is dead money, stuck in a purgatory between declining cable assets and expensive theme parks. That is the safe, comfortable take you will hear on cable news. The reality, however, is far more aggressive. While the market was busy debating who will sit in the CEO chair next year, Disney has quietly executed one of the most brutal and effective financial pivots in media history. They haven't just stopped the bleeding in streaming, they've cauterized the wound and turned the direct-to-consumer division into a legitimate profit engine that generated over $1.3 billion in operating profit for fiscal year 2025. The narrative that streaming loses money is effectively dead. The company isn't waiting for a savior, the turnaround is already happening on the balance sheet, and the market is only just beginning to wake up to the discrepancy between the old cash-burn Disney and this new, leaner operation. Let's analyze the recent price action because Friday's move wasn't random. Throughout the last 2 weeks, we have seen DIS stock consolidate in a tight range between 102 and 106. This compression usually precedes a breakout, and the volume on Friday, ticking just above 10.7 million shares, indicates that sellers are running out of ammunition. When you look at the charts on your interactive broker's trading platform, specifically if you pull up the 1-hour candles, you will see a higher low structure forming since the post-earnings dip earlier this month. The stock is respecting the 50-day moving average in a way it hasn't for the better part of 2 years. For those of you who utilize Schwab Intelligent Portfolios or similar automated allocation strategies, you might have noticed a slight increase in exposure to the communications services sector recently. This isn't an accident. Algorithms are picking up on the improved free cash flow yield Disney is now offering. When you invest online or manage your own individual brokerage account, it is easy to get fixated on the daily headlines about box office numbers. But the smart money is looking at the debt reduction. Disney has paid down billions in debt over the last 12 months, deleveraging the balance sheet faster than Wall Street anticipated. Now, we need to address the elephant in the room, the fiscal year 25 Q4 earnings report that dropped just 10 days ago. This report was the catalyst for the current tug-of-war we are seeing in the price. The headline numbers were a classic mixed bag that confuses the algorithms but provides opportunity for the human investor. Revenue came in soft, hovering around $22.5 billion, which was basically flat year over year. If you only look at top-line growth, the stock looks stagnant. But looking at the bottom line tells a completely different story. Earnings per share came in at $1.11, beating the street consensus of $1.03. Why does this matter? Because it proves that Disney has regained pricing power. They raised prices on Disney Plus and Hulu, lost virtually no subscribers. In fact, they grew the combined subscriber base to 196 million. This is the Netflixification of Disney. For years, the criticism was that Disney was just chasing subscribers at any cost. Now they're chasing profitable subscribers. The ad-supported tier is now accounting for nearly half of new domestic signups, which is crucial because ad-tier users are actually more valuable over the long term than premium ad-free users due to the recurring ad revenue stack. If you are using SoFi Invest or checking your Robinhood app to gauge sentiment, you might see a lot of chatter about the linear network's decline. Yes, traditional TV is dying. The linear network's operating income dropped again this quarter, down significantly as cord cutting accelerates. But here's the contrarian take. It doesn't matter anymore. For the first time, the profits from streaming are starting to offset the decline in linear. The crossover point, the holy grail of the media transition, has arguably been reached. The expectation was that linear would drag the stock to $80. The reality is that streaming is acting as a parachute, and soon it will be the jetpack. Let's verify the institutional flow. If you look at the holdings data from Fidelity Investments, specifically within their large-cap growth funds, there has been a subtle accumulation of DIS shares throughout Q3 and early Q4 of 2025. Fidelity mutual fund managers are not buying this stock for a quick flip. They're buying it because the valuation has compressed to a level where the risk-reward ratio is heavily skewed to the upside. At a forward PE ratio that is now trading at a discount to the broader S&P 500, Disney is being priced like a company in decline, yet it is forecasting double-digit EPS growth for 2026. That is a mispricing that Fidelity Wealth Management advisors are likely highlighting to clients who want blue-chip exposure without the nosebleed valuations of the tech sector. Speaking of tech, we have to talk about the competitive landscape. You cannot evaluate Disney without looking at Netflix. Netflix stock has been on a tear, up nearly 25% this year, while Disney has lagged. But notice the gap closing in terms of strategy. Disney is no longer trying to be everything to everyone. They are bundling. The integration of Hulu into the Disney Plus tile was a technical success, reducing churn, a fancy word for cancellations. When you invest online through investing sites that offer research tools, compare the churn rate of Disney Plus bundle versus the standalone service. The bundled churn is significantly lower. This sticky ecosystem is what creates a floor for the stock price. Furthermore, we need to discuss the Parks and Experiences division. This is the engine room of the company. Expectation was that a slowing economy and inflation would crush theme park attendance in late 2025. The reality? International parks are booming, up 25% in operating income. Domestic parks were softer, yes, but per capita spending is up. People are visiting less but spending more when they do. Plus, Disney is about to launch 2 new cruise ships in fiscal year 2026. The cruise line has the highest return on invested capital of almost any business segment they own. It is a cash machine. While the market frets over lower attendance at Disney World in Orlando, the company is effectively sold out on its cruise bookings for the next 12 months. This brings us to a critical interaction point. I want you to pause and think about your own portfolio. Comment below how many shares of Disney you currently hold, or if you are waiting for a dip to enter. Also, let me know, do you think the price hikes on Disney Plus will eventually backfire? Or is the content library strong enough to keep you paying? I read every comment, so let's get a discussion going. Now let's pivot to the technicals again because this is vital for anyone trading the stock short-term. On the daily chart, we're seeing a golden cross setup potentially developing if the stock can hold above $108 for a few consecutive sessions. The 50-day moving average is curling upward to meet the 200-day. If you are active on Robinhood stock trading forums, you know this is a massive psychological trigger for retail buyers. However, there is heavy resistance at $112, a level the stock has failed to breach 3 times in the last 6 months. If it breaks $112, there is very little structural resistance until $125. Conversely, if the macro environment sours and we see a broad market sell-off, the next major support zone is down at $90. Let's take a step back and look at the company structure for those who might be new to the stock. The Walt Disney Company is a diversified international family entertainment and media enterprise. It operates through 3 core business segments: entertainment, sports, and experiences. The entertainment segment includes the film studios, Marvel, Pixar, Lucasfilm, the streaming services, Disney+, Hulu, and the linear networks, ABC, Disney Channel. The sports segment is essentially ESPN, which is currently undergoing its own massive transition